It's always a pleasure, to be among the friends. It's not a web cast where one is speaking and all of you are listening. It's a basically a dialogue where all of us are on the same level of learning. It's as has been said by many people that we have been picking up pebbles when the ocean of knowledge has been lying in front of us. So when we learn, the more we read, the more we come to realize that there is more to read, more to know. So this is a journey. There is no end to it. There is no, goal where you reach and then say that, okay, now it is over. All of us are on this journey. And among this, there are many stoppages. We stop, we talk to another, and then proceed. Today is one of the stoppages where we are talking, we are trying to find out how the world of taxation is going to unfold in the near future. And all of us have lived with a particular system of taxation, which was the product of a concept where physical presence has been of paramount importance for acquiring the taxing right by any jurisdiction. With the digitalization and globalization of economy, the entire thing is changing. Gone are the days where one has to be in a place to render a service, to effect a transaction in goods. Being away, one can carry out all those activities. Now, this is giving sleepless nights to the tax authorities. It is becoming very challenging for the tax authorities to identify where does the situs of income lies, to what extent the income should be subject to taxation, and what would be the mode of taxation. All these are becoming very, very fuzzy. And in this scenario, the global international organizations like G20 and OECD have put their mind together, and they have appreciated that a lot of profit is shifted, thereby eroding the tax basis of the countries. The amount can be anything. You can read, in various journals giving the figure 100 billion US dollar, 4% of the GDP. All those figures are guess estimate at the best. But the problem is there. The problem is there for the business also. How to ensure, and for the advisors more so, how to ensure that whatever structure is put in place depicts the reality of the business and at the same time meets the other end of disclosure of income to the fullest extent and in the truest manner. So these are the challenges which the global international organizations appreciated. This resulted in BEPS project. In 2015, the 2015 BEPS came out with Action Plan 1, and that was addressed as addressing the tax challenges of the digital economy. So you can appreciate that globally, the tax administration as taxpayers and the tax advisors are putting their mind together to come up for a solution which will be effective and will be equitable tool for taxation of the digital transactions. More than 130 countries have joined together as an inclusive framework, and they have been working overnight, you can say. You all must be reading in various forums or listening to various speakers, the things which are being put by the international organizations. In fact, the inclusive framework came out on 12th October 2020 with a package number 1 in respect to the Pillar 1 blueprint and the other Pillar 2 blueprint. The 2-pillar solution is being perceived, is being recognized as the best possible solution. It is a historic development. You can say it's not going to be an incremental change in the taxation law, maybe a revolutionary change in the taxation law. And this is going to rewrite the century-old tax laws and will affect all large groups. The two-pillar approach considers certainty, fairness, and sustainability as the motive behind the solution, and at the same time are mindful of the sovereign's taxing right. The challenge before the drafters is to ensure that no country is perceiving the changes, perceiving the plan as actually affecting their sovereign right, because taxation is a sovereign right and every country is very much attached to that to meet the ends of end of their population. So it's going to be a very big challenge, and let me give a very high level a picture of these two pillar approaches. In fact, pillar one, you can say that pillar one to some extent develops on the tax law which is existing today. Pillar two makes a very big change in the whole concept. Now, in case of pillar one, if you look at what it tries to do, I mean, I think Partho will take you through in a more descriptive way, and I do not want to say things which he will be talking in a more erudite manner. Is that assigning the taxation right to the jurisdictions where income is earned. And friends, I mean, this is the issue which has been bothering particularly the developing countries. They have been very aggrieved by the fact that though the income is earned by the big multinationals, and to correct myself, now it's not only the developing countries, even the developed countries are very, very impacted by what's happening. And they are bringing in many changes in the tax law to ensure that the rightful amount of tax is paid by the big companies. And that is why in case of pillar one, the threshold which has been put is pretty high, that is euro 20 billion, which is likely to be reduced, and the path will be told by Partho to a lower amount, and also 10% profitability. So these two things will go together. And the pillar two requires multinational enterprises to pay at least a certain amount of tax, which is 15% is put as the base amount. So one must, I mean, pay tax. If it is lower, then in that case that will be jacked up, and Monika will be covering, I mean, the way forward on this. Now, when we look at this pillar one, it applies to 100 of the big and the most profitable multinational enterprises, and it is divided into three parts: amount A, amount B, and the third is the tax certainty. These are the aspects which are covered in the pillar one blueprint. When we talk about pillar two is going to make a really paradigm shift, because this is one where both the developed countries and the developing countries have been actually worried that the multinational enterprises are not paying taxes either in the the area where they generate income, or in the area where they they get registered, but park their income in very, very tax friendly regimes. So there they are looking at a situation where the tax amount has to be 15%, and to ensure that the two approaches which are being debated, being concerned, are one is the top down and the other one is top up bottom, or top down approach and top up tax approach. These are the two approaches which Monika will be taking us through. there are various estimates. I mean, what will be the result of pillar 1 and pillar 2? That's the question which all of us and everybody will be having. And what OECD has come up with an estimate is that pillar 1 will generate approximately 100 billion US dollar of tax, which will be distributed among the countries involved. And pillar 2 will generate almost 150 billion US dollar. Monica, I mean, over to you to correct me when you speak. So 150 billion US dollars. So these are the huge amounts which everyone is looking at. Now, the question comes, how are these two pillar approaches going to impact the businesses? The two pillar solution represents, I mean, as I said, historic development and seeks to rewrite the very, very old, I mean, tax laws. In fact, the tax laws which we are following, implementing, advising is a product of 1920s, 1930s. And that has been, I mean, adopted by all the countries in the form of tax treaties. So the tax treaties are also, I mean, the concept of permanent establishment is the one which very clearly brings out that the physical presence, either directly or indirectly, should be at the base. It is very important, I mean, from the Indian perspective of the Indian businesses, whether it is India outbound transaction or outbound business entities or entities which are looking into implementing, I mean, their business proposals of establishing themselves in India. For all of them, this pillar 1, pillar 2 are going to impact the way they would be, I mean, conducting their taxation. I won't say, and I am of a firm believer that it is not the tax which should wag the business. Rather, it is the reverse way. The tax should ensure that the rightful amount of, I mean, taxation total system should ensure that right amount of taxes are paid in the country where the income is generated. So in this background, when we wait to hear and when we hear from Partho and Monika, it's going to, they are going to unravel the mysteries, I would say, today in the two things, because we are looking at, I mean, what IF is coming out is that they would finalize pillar 1 by end of 2022 and to be implemented in 2023, and equalization levy should go along with that. So a lot of things are being, I mean, debated. But when I was reading, I mean, pillar 1 computation, I mean, though being a student of physics or mathematics, it is not an easy thing to understand. So we'll have to wait, I mean, how it's going to be implemented. A lot of doubts would be there, but when one moves from one to the other system, initially there will be hiccups. So let us hear from Partho and Monika. Over to you, Partho.
Before we jump in, so I will take you back a little bit before the pillar 1, why it has come, what is the purpose it has come, and what purpose is going to serve at the end of the day. If we have a objective, then there is a purpose, and how it is going to serve throughout our journey, and how as a industry or a professionals we are going to work on that. So this is the 3 challenges, which is the main policy challenges that has come up during this entire digital economy, is the characterizations of the payment made in context of the new business model. Now, then there is a nexus, because as SP mentioned, that there is no need of physical presence, which we have been having a sense when we studied our CA, or we have been practicing for so many years. And then we have a nexus, then how do we attribute to the nexus the amount of income? These are the 3 main policies around which it is driven about the digital taxations. So these are the administrative challenges also, because when we talk about the importance of the administrative challenges is the tax certainty, amount A, amount B, and the tax certainty. So this is where how to collect the info. I'll also walk you through the areas what I feel as a and is where we feel that there is a challenge will come in collections of the informations. And I'll give an example along with the present transfer pricing issues that are coming up. So the first is came the plan one, which is the digital presence, digital service tax, and the withholding taxes. Now, what is a digital presence and evidence as to interactions with the economy of that country? Digital service tax, we talked about equalization levy, which SP also touched upon, how it will continue. And then how do we stand alone on an withholding tax matters?
Hello.
Yeah. Is it something? Is it fine? Or should I continue?
I think you continue, Partho.
Continue, Partho, sorry.
Okay, then came the BEPS 2.0. And the BEPS 2.0 came up with, as we talked about, is the tax challenges arising in the, and there's a blueprint came again, which has been referred by SP in his opening remarks. And then came up with the two pillar concept, pillar one and pillar two. So pillar two, but when we talk about pillar two, I will leave it to Monika to explain into much more details. So pillar one, there's a concept, and it will be more better explained if I look at into this slide. So there are, what are the objectives of the pillar one? A new Nexus rule. If you look at if you remember the first slide, the challenge, characterizations, and then the Nexus rule. Because we don't have any physical presence, how do we come up with the Nexus rules? Then how do we reallocate the taxing rights to the place? So the pillar one, the major thing that came out in the pillar one in BEPS 2.0 is the concept of market jurisdiction, customer jurisdiction. So that's one of the important, evolutions, or as we call this, a very important concept that came out on the market jurisdictions or the customer jurisdictions is the major concept, moved away from the physical presence to the sitters has moved to the markets. So that's where the major revolution that we are talking about. Now the Nexus rule comes in. How do we reallocate the taxing profits? Simplicity, how to withdraw simplicity, and ALP, it's going beyond ALP. These are the major objectives that we came up on the pillar one. So essentially, if we come down to, there are three elements. Pillar A, amount A, which is about digitizations, taxations of the company. I will explain in detail how one can arrive at digitization, how can you arrive at the taxation, how will the detailed stepwise calculations. Then we come to the amount B, which is a baseline marketing distribution activities. Again, a very detailed presentation is there. What is a baseline marketing distributions activities means, what are the key elements we need to understand before we conclude that it's a baseline marketing. Then the major concept is the tax certainties for the MNEs as well as for the administrators. At the end of the day, OECD never pushes for litigations. At the end of the day, OECD is always likes that the administrations should have the simplicity, understand, and there should be minimum litigations. The tax certainty to the industry, to the MNEs, should be there. With this objective, I'm moving on to the first element of the amount A, and how the amount A and B is there. This slide gives a pretty much where the amount A is considered. So amount A has got three elements. Business activities, that means what are the in-scope activities for which the amount A will trigger. Second point is the revenue threshold on which it will trigger. Part of it has already been discussed by SP on these whole things. Then we come down to the Nexus rule. So in-scope activities, revenue thresholds. Then once we come to that, there's a nexus. How do we come to the nexus rule? How will we say that this is a market has come? These are the markets, and this is where the profit needs to be reallocated. How do you compute the tax base? And what is the way of allocation? How do you allocate the whole things? And for tax certainty, elimination of double tax. Come to the amount B, it is the scope. Again, it is amount B as of now is not a full-fledged kind of an quantum quantifications on the how it will be applying. But conceptually, the scopes are there. Then there is a quantum that they are in the process of debate or discussions going on the amount B2 coming up with some certainty. And then obviously the tax certainty is the major issues, and which is the three areas on which we are going to discuss. I'm moving on to now amount A. If I look at an amount A, in this slide, I will only discuss in-scope activities. I will not discuss revenue threshold, which I will discuss in my next slide. So in-scope activities as defined in the blueprint is there are two things. One is the CFB, they call is consumer facing business. And the second is the automated digital services. Okay. Now what's a consumer facing business, which is what currently we understand the business. That means wherever in the market there is a consumer facing is there, and the way the traditional businesses are going on are the consumer facing business. I am not going into the complexities of whatever is given, but that's in a simple manner is the traditional way the business have been taken on is the consumer facing business. New concept, automated digital services. Now, what is an automated digital services? The word automated means where you are delivering a service or goods with minimum human intervention. Digital means where the services are being given in an automated part over an internet is the automated digital services. That's the definitions in the blueprint. And again, just to put my word again in this way that I'm trying to put this thing simple and not getting into much of the complexities, because then it will never end. This whole discussions will never end within the time frame. Now, so in scope activities, so let's say first is in scope, divided into two parts: consumer facing business, second is the automated digital services. Now, what they have done in both the cases, in both the kind of businesses, they have created a positive list, they have created a negative list. Positive list is the list on which it will apply. Negative list is the list on which this pillar 1 will not apply. Amount A of the pillar 1 will not apply. They will be outside the scope for applications of pillar 1 or the amount A of the pillar 1. So in a consumer facing business, the two kind of businesses have been kept out of it. One is the extractive business, another is the regulated financial services business. And let me give you some definition what they're talking about. What is an extractive group of this? What is an extractive group means? What do you mean by an extractive activity? It is engaged in the explorations, development, or extractions, which is a natural resources. It derives extractive revenues, which is the aggregate having a substantial connection with the explorations, development, and extractions. oil industries, oil and gas industries. So they will be out of it. So then they go into the detail. What do you mean by development? Development means process of drilling, excavations, and the construction of the explorations, extractions facilities. Process of then exploration means searching and evaluating extractive product. Extraction, so it is more of a natural minerals resources companies which is into extractions, develop this process of how do they do the process of drilling. So it's those kind of companies are. So activity means explorations, development, extractions, primary processing and qualifying, transportations. So this full list of value chain is an extractive business. So the extractive business is the company which is a company, and that element of that company, that segment of that company, I will discuss how important is the segmentation, becomes an important areas for our discussions and understanding. So they are not within the scope. Again, what is a regulated financial services? Now, regulated financial services are very, very simple. Asset manager. So asset management as a business under the law group, credit institutions, deposit means any funds which are required to be repaid on demand, like fixed deposits and all that, depository institutions, and financial assets means a money market instrument, security, commodity, that's a physical good, where it is held as a hedging position. It is only the hedging positions. Money in currency, that is the banks would be out of it, an insurance contract, annuity contract, insurance products. So these are the all elements which is outside the scope of, and one of the important is also the international airs and shipping businesses, but that's a separate issue. I will not cover much on that. But these are the regulated financial services and the extractive business are the key definition for us to understand as we go forward on this. Similarly, on the automated digital services, there is a negative list. There is a negative list that is given on the side, which is like customized professional services. Like we suppose we as a firm providing any services outside our country, or somebody we are receiving services, those are outside the scope. Customized online teaching classes. These are all the negative lists of the ADS. Positive list is pretty long, which is here are some of the samples we have given. It's not an inclusive of everything, but these are the more of the guidance factors. This is the kind of the services that we are talking about is online sale of user data, search engine, social media platforms, digital contents. I'm just reading from what is there, and it is all in the purview of the automated digital services. So in-scope activity means if a company having these businesses under its businesses and not falling within the category of negative lists are in-scope activities that gets covered under the amount A of the pillar 1. Now I will pause and hear from you if there is any comment or if there is anything that we would like to understand better subject to my expertise, or if you need some more time to just breathe in what I have just told, then I'll move to the calculation of the revenue thresholds. I'll just pause it for a minute or so.
Sir, with the high threshold of 20 billion, do you think, sir, that a developing country will get their due and legitimate shares here? Because the threshold is very high, sir.
Okay, I will, Prakash, what I'll do is when I go to the threshold, because this is the Up to this, I've defined this Inscope activities. I'm going to threshold and I'll respond to your questions when I'm going to the thresholds. And how they might come into the picture is also what I'm going to talk about. And how the whole things will get probably some clarifications to the extent possible. Okay, since Prakash has already raised this concern about thresholds, let me move into the revenue thresholds. How do we measure and calculate the revenue thresholds? Now, we looked at the covered group. Here, the covered group means the ultimate parent company where the financials are getting consolidated. They call it in a very, if you read the various OECD guidelines and reports, it talks about UPE, ultimate parent enterprise. So in a covered group, if you look at a covered group, we will see first is $20 billion euro. Sorry, 20 billion euro is the sales or the turnover of the company, the consolidated financials. We'll talk about what do you mean by consolidated financials in my coming slides. Then there is an and clause, not or clause, and the PBT should be 10%, should be minimum 10%. That means 10% or above is qualified to be a covered group. So once we understand that this is the to my best of mathematics, 20 billion euro would somewhere come to 2000 crores of turnover, if I'm not mistaken on my zeros. So this is where the Prakash Bhai's the Prakash Bhai's is the concern that it's such a high volume and how it will work out. So what will happen for large UPEs? There is a requirement of a segmental accounts. The segmental accounts will have segment 1. Let's say there are 3 segments primarily. That is, one is which qualifies under the positive list in the CFD or automated digital services, and there are other is the extractive or they have RFS services. So we will remove those 2 financials out of the segmental of the UPE group, the UPE, in order to consider the threshold of 20 billion and 10% profit. And then it has got a multiple segments. If we remove them, then balance is the other segments. And the other segments will have various segments of businesses that the company would have. And in a segment where the threshold is more than 20 billion and the profit, both the conditions are satisfied. Here in my example, I put this segment 1 will become the qualifying segment report. So now the entire allocations from here will not come, will start from this segment 1 only and not from the entire covered group business. So we will divide it, come out where it is applied and where it is not applied on these companies, starting with anybody more than 2000 crores profitability, take them out, and after taking this extractive or RFS, if they have only one segment and that is below 2000 crores or 20 billion euro, and then they are out of amount A of the pillar 1. If not, they will become the part of the compute for the purpose of computations to the next stage of the computation, the qualifying as a so there they're saying it is a segment reporting of the covered group. Okay, so from here, if I move to the next point, so this is the in-scope activity, revenue threshold. These are the 2 things that we talked about. that slide where we have the blue pictures, where we have this blue pictures, business activity test and revenue thresholds. We have covered how to come into and how to arrive at that. Now we'll come to the second basket is the Nexus. This is the Nexus rules. Nexus is depending on the market from where they are getting business. The customers market from where they are going to get business. Outside this place where they are, do not have any physical presence. And has been done through either through a CFP or a ADS, which can be either way. Now, how they have done, so there may be companies within 20 billion segment, 10% profitability, but their market from which they get the amount is insignificant. Do they have to still carry on this kind of allocation? The answer to that is given in this table. That revenue from the covered group from a jurisdictions, which is to be found under Nexus rules, is 1 million euro. And whereas the GDP of that, so they have linked it up with the GDP of the country or the jurisdictions or the market. Why they have linked it to the market jurisdictions? Because if you have a larger GDP country, potentially the customers or the demand or the market is larger. So the value has to go up because I am working in a larger market, a larger demand. Where the GDP size is small, I have a lesser market, smaller market. So my customers or the market in which I am going to penetrate will be small. So that's why my entire Nexus element has come. Now, the important question is, how do I know, how do I determine how this money has come from market A, market B, market C? Forget about GDP. What is the technique? How do we go into that? How do we say that this is where the revenue has come from? So they have, like, to a large extent, like GST, we have various point of sales. We say here is the sales means this. So this is just again a very, very broad table. There are many, many line items to this. So these are the place of delivery of the goods to the final customers, location of the customer, place of use of the digital goods. So these are the various informations that would trigger in order to calculate the revenue coming from the jurisdictions. Theoretically, it is very nice. Practically, I'm just covering it before because it will come into tax certainty areas, but practically any companies or MNEs for that matter, keeping a track, keeping and getting these informations, which will be so transparent manner that the MNEs, that the tax authorities in respective countries can really vouch that this is information is correct. This is where the first level of challenge on the tax certainties, to my view, would start coming in on the information gathering, because these are the various points. And from there, from these various points, you need to, suppose you even qualify, then how much it is coming from each of the market has to be based on this guidelines, is where all of us will face challenge. And how do we change the ERPs? How do we change the entire process of collection of these informations at easily from the clients or from the companies is a real challenge. Even today, all of us are having a real challenge in the management services, how services have been rendered, in what way the services have been rendered. It is largely between two countries. So this will be a bigger challenge in collections of the informations. Now we covered the Nexus rules. We covered the sourcing rules, how the sourcing will be made. So both Nexus and sourcing is to be done. Now, how do we determine a tax base? Tax base determination is a little bit complex, but I'm trying to work it out in a little bit simpler manner. Whatever I understood is the UPE, the ultimate parent company, has to be maintaining its financials, audited financials in a recognized accounting standards, preferably even IFRS, which is internationally accepted accounting standards. And from there, financial statement as per the qualifying financial accounting standards. Then we have a book profit, which is the PBT. When you're talking about book profit, we are always talking about PBT. Then there is some allowed procedure for adjusting the book profits. Now, I will give you the examples of what are the elements that are need to be adjusted from book profit to tax. Before I jump in, I'm sorry, I missed out the question of Mr. Prakash to respond. Is that Mr. Prakash? There are this whole amount A, my guess, is targeted for the larger companies. Then we go to the larger companies. We looked at the turnover and thresholds. Now, even after cutting down extractive and RFS segment, and if there is still an huge amount of amount is coming, whether in context of Indian outbound companies, there may not be much, but there will be. It will not be zero. It is more from the inbound perspective, because when we do an tax allocations and coming out of the tax certainty, and then there is a business on tax certainties with the tax authorities, how do they implement these tax authorities is where I think the whole scenario, the dynamics of this amount A of the pillar 1 will change. That's my view. And I'm not sure whether, Prakash, this I've responded to your query to the satisfaction of yours, but that's the way I would look, because there are two kind of categories. One is the outbound companies, Indian MNEs, and there are some inbound companies, or there are companies which are headquartered out but having a business or market from India. And India is a large GDP. Okay, now if I move on to book to tax adjustments, so there are certain elements they are saying has to be taken. And again, there's a loss carry forward, loss rules are there. So tax expenses has to be excluded. Dividends has to be excluded. Equity gain or loss, which is like for us is a capital gain or capital loss, equity gain. Prior period errors or changes in the accounting policies that needs to be looked at. Financial accounting of the excluded entities have to be excluded. That means that which are into extractive or non-RFS has to be excluded, both from the top line as well as from the bottom line. So making these book to tax adjustments, and there is also some adjustment they are talking about on the marketing and distributions, which I will cover it as a part of an amount B, but this will also cover into book to tax adjustments. Then there is a concept of loss carry forward, how that will be carry forward, and how it will be taken care of in the future. Because when profit is to be distributed, how loss will work is also very important to understand.
Sir, one important point.
Sure,
uniformity in the accounting needs the uniformity in the interpretation also. This type of situation can raise lot of dispute also.
Yes.
So is there any dispute resolution, proper dispute resolution which mechanism that will work here? I am going forward here, but that is the question which has come to mind here. So I thought that, okay, just ask.
No, absolutely. See, there are I have read the progress report of the amount A. I don't know before you've been invited for these presentations, number of times. That used to be sometime on the weekends. I used to read this number of times. And to be frankly, even there are a lot of doubts in me. Having said this, there in the OECD there are various multiple uh, accounting firms, law firms has given their comments on this amount and pillar, amount A, on the progress report. What are the issues? What are the challenges? And there, the same issues that you were talking about is also been talked about. How do we navigate the interpretations? How do we navigate on the tax certainties? Where there's a lot of administrative challenges will come. This will be there. And if SP, you have got any further points to that to add to clarify what Prakash just said, please go before I move to the next points.
In fact, Prakash and Partho, Partho mentioned right in the beginning that there are three limbs to Pillar 1. That is, amount A, amount B, and the third one is the tax certainty. So, considering this, I mean, as rightly said by Partho, there are efforts being made, I mean, because everybody appreciate that there are big gaps in the definition itself in, the blueprint. The definitions in various places are given. So that's one origin, I mean, for the controversies and litigation. Plus, as Prakash, in fact, raised a very, very important point, which will, I mean, draw the attention in the years to come, is that, in different countries, they have different ways of maintaining the books and computing the income. To have, I mean, a single approach globally is going to be very, very challenging. But having said this, I mean, one way is to look at that. Let us see how it progresses. This is what, in fact, OECD is trying to impress upon everybody, that please accept it, and as and when the problem comes, we will try to solve it. We have, I mean, our own, the doubts if this approach will work it. I mean, whether they should do some sort of a dry run in a smaller area, and let's see whether it is possible or not. And this, I think this may be in the back of their mind, that a very high threshold of $2 billion, 10% profitability. These things have been kept so that in the initially only 100 or so multinational enterprises are going to be covered before they increase the basket, because the controversy will become much larger when the basket is increased. So there are two limbs to what I mean, my response to Partho's question is, the one is, how to, I mean, who to address, how to address, because these are the two very basic questions. I mean, who are the companies which are going to be covered under this, and how is going to be covered? So there will be, I mean, dispute. There is no doubt about it. In fact, if I go back, I mean, my days, I mean, before 2000, when we are trying to draft the transfer pricing regulations, all these questions were raised wherever I went and tried to understand the feeling of the people before bringing in the transfer pricing regulations. But this appears to be a very, very involved computation. But let us see, I mean, because all of us have given a representation to the OECD to simplify it. How, in what form finally it comes, a lot will depend upon that. And India, being a large country with very, I mean, advanced, I mean, I would say advisors and the tax authorities, but there are countries which don't have this luxury. So how they are going to implement will be a challenge, Partho.
Sure. Thanks, SP. So this is where, as I'm saying, this is where this slide will again create, as in the previous one I said, there is a issue will come in implementations and collections of informations. Then this is the where it is the implementational issues. And I've seen everybody's, because it's available on the comments given by most of the larger law firms and accounting firms, including us. There are similar level of questions that what Prakash has been raising. Now I'm moving on to we have determined the tax base now. Now, how do we do the allocation? So now they're in allocation, they have said, we are saying a 3 steps approach. Profitability, after removing everything, then we come that what is the residual profit? What they are saying, if any profit which is more than 10% of the profits. So they say that you are qualified if you are 10% of the or more profit. Now, in excess of 10%, 25% of the amount will be redistributed or to be reallocated among the various markets. Now, how these allocations will come? So here we found the basket. Okay, this is the 100 is the total amount which needs to be reallocated. This is the mathematics. There's nothing much. Now, how do we allocate these things? There's a reallocation. We arrive at the reallocation percentage. Then we apply an allocation key. Mostly recommended allocation key is based on the revenue. So there are potential approaches that they say is the profit-based approach or a revenue-based approach. The recommended approach is, as of now, is based on the revenue of the market, and that it will go there. So it again takes me back to the same slide, that the information of the nexus, if it does not come coupled with the question that raised by the Prakash, is that 2 elements are not coming stitching one and again another with each other, then this entire exercise becomes challenging for any tax authority. So this is again the elimination of double taxations. This is where we bring about the tax certainty positions, and where there is they have given how to deal, eliminate. So this is a real. This is where it is going to be very tricky matters, bring it on so that we do not pay taxes in both the places. Now, let me pause before we jump into B. Though I have not much time left, still I would like to give a pause to people to digest a little bit of amount A. I'm sure everybody has read it, and if they can relate or where they cannot relate, we as a panelist members are here, and if we can, will be helpful if all of us can throw lights. Now I am moving on to the amount B. Conceptually, amount B applies to all business sectors as of now. Okay. Amount B applies to the all business sectors as of now, and intend to standardize the remuneration paid to distance carrying a baseline and marketing it. Now, for the time being, let's keep this baseline marketing. What I'll explain what it is in the slides to come. Now, so this is where they fixed this quantum is still to be coming up. Thresholds are still to be working on. So then, what is a positive list and what is a negative list within the concept of marketing and distribution services? So before I jump into that, and before I get into my next slides on the importance of the definition of baseline marketing and the importance of FAR is very important, because if I go to the next slides, we are talking any entities in India or anywhere which is into marketing and distribution activities. They are covered in the amount of Part B, amount B. Now, how do we define what is a baseline marketing and distribution activities? In order to arrive at that, we need to have a detailed FAR of the companies, which you all do when you do a transfer pricing studies on the functions, assets, and risk analysis. Now, while a company, all the marketing and distribution companies will not get covered under this. There are certain functions, there are certain assets, and there are certain based on this FAR analysis. You either get covered into this baseline marketing or distribution activities. Others are not. Now, primary concept that they have said is that we are importing goods from related party and selling it to the third party customers in the jurisdictions. Okay. This is primarily for the resale activities that we are doing. Activities that get covered, that if you are development of execution of sales budgets, plans within the market, the word within the market is very, very important. Within the many group guidelines and arise oversight. So we are developing a marketing plan in India, let's assume. But this plan or the strategy that we are doing is a subset of the overall global plan of the MNE. And under their supervision, we are working. So if we look at this, we are not we do not take an entrepreneurial risk in this case, because we are always guided our sales strategies, pricing based on the MNE strategies. We are doing it for locally, so we do not have. So when you're talking about these functions, function takes us to the risk, and the risk says you don't have the entrepreneur risk in this case. You can make your local customer relationships, that marketing intangibles, that even if you have, does not matter. Again, pricing, everything under the supervision of the MNEs, of the global MNE strategies and structures. Even the processing of the orders, that is all covered in this way. So marketing activities, what it would like to cover is the pre-sale services, execution of global marketing plans, translations, advertising material business into website to local language. There is a global, local language, and routine after sale services. Like suppose I bought and sold something, there is some installations required. I go and do the installation. It's a routine services. There's no issue with this. What it does not include, if I am doing a tempi function. Today we have plethora of rulings, case laws going on, the MPs and tempi functions and all that. This is where they will not be covered. They are out of scope. So these are the where you don't have a centralized marketing structures. We don't have decision on the centralized basis is where we need to we don't have a centralized strategic business plans. So in a nutshell, I'll come to the risk also. In a nutshell, we call it as a limited risk distributor for the purposes of these activities. Sorry. So in a limited risk distributors have a limited market risk, no to limited credit risk, very, very limited credit risk, no to limited inventory risk, back to flash title. The concept of flash title comes here. No to limited foreign exchange. Suppose there is a losses and foreign exchange gain that is to be compensated by many. So today the definition of limited risk distributors falls within most of these elements of the limited risk distributor falls within the in scope activities for this amount B. So this is in nutshells is that's the coverage of the amount to B on the marketing and distribution activities. The works are going on the thresholds and the amount that to be taken up. So qualitative factors, I mean strategic sales, marketing and DMP functions, all that I just explained in a detail the way one is to be identified in this way. Again, it's again the process. Now here there's a very beautiful concept that have come up, is called rebuttal. So they said that the appropriate PLI would be on the TNM and return on cost or sales should be the appropriate PLI for determining the arm's length price depending upon the products, market, industry, all those things. But you have you can rebut. There's a concept of rebuttal where you can go and say that I'm not agreeing with these policies or the regulations that you are dictating to me. I have a better set of comparables, which may be most preferred is the cup. If or there anybody has got a cup, is where then you can rebut to this agreement and say I will follow cup because my data has got cup and this can be done. This is where I'm trying. This is I found it a very good concept in that I don't have to be necessarily following it. I have a better things to follow, and if I can prove, for example, CUB will be accepted by the should be accepted by the tax officers. Again, the question is dispute preventions and tax certainty is the underlying questions of the entire things for the entire stakeholders, be it tax authorities, be it M&Es, be it consultant. All three are looking at how do we help in developing a tax certainty without much of an issue. So with these things, I complete my presentations. I have probably stepped on to Monika some of his time. I don't know her time. Sorry for that, Monika. And any questions, answers, either you can post it now, or maybe my email IDs are all available. Can post it later on. It is up to the chairman's approval. I hope I could give some basic understanding. It's a complex subject. I completely understand. Thank you.
No, so Partho, thanks a ton for your excellent presentation. I was just looking at, and you know, my calculator was failing me when you talked about the $20 billion, 20 billion euros, not dollars. And 20 billion euros, to my mind, is about, you know, even if I converted it 80 rupees, it comes to about 1,60,000 crores.
Okay.
I mean, I was just doing the zeros, and you know, and I actually confirmed with Richa also. I said, am I correct in doing it, or am I somewhere half asleep? You know, because this number is huge. And I think, as you mentioned, and I think Mr. Singh also mentioned in his opening address, there would be a debate on this and whether this figure is right or this should be brought down. Because I think the point which Mr. Singh also had made. Because 20 billion euros is huge, sir. I mean, 1,60,000 crores. How many entities would get covered in that kind of a revenue? I'm sure there would be some. I think someone mentioned about 100 odd entities are covered.
Yeah, I think that's why I completely concur with Prakash's comment about Pascal's comment in the IFA on the values of the revenues that they're going to get, on the certainty of the values of the revenues that is expected.
Yeah.
That's what it is, my belief. But these are the larger companies, especially the IT and this tech companies probably would come into this purview, and that's what probably the major aim of the tax authorities or the VCTs in this area. Which SP can throw more lights onto that.
I think all the discussion, all the papers which have come out recently from the OECD are directed towards amount A. So we have to see. I mean, they are yet to get. I mean, the response from the people in respect of amount B. How is that to be computed and all those things? I think in that respect, they are falling behind the timeline which IEF inclusive framework set for itself. So Partho, I feel that amount B has not yet reached the same level of certainty as has been done in case of amount A.
Sure. Yeah, because amount B, they have not yet clarified on the quantum or thresholds, how they just a conceptual note has come only.
While Mr. S.P. Singh has already set the tone of today's session, and we have already looked into some of these slides and understood the topic of Pillar 1, in the interest of time, let me directly start with Pillar 2. So friends, all of you would have learned about globe when you were in school. So the objective to learn globe when we were in school was to understand from the geography perspective, countries, continents, territories, etc. Again, we are back to those school days. We need to learn globe. The perspective is different. The perspective is that which country will tax what income, how much it will tax, and if one country doesn't tax, then the right goes to whom. So with this small note, let me start with Pillar 2. So friends, this slide contains a detailed index about all the topics which we are going to discuss under Pillar 2. So I will not read this content slide. We will deal with each of this topic in detail. Just to set the tone on the Pillar 2, as SP Singh sir mentioned, the genesis of BEPS action plan came right from BEPS 1.0. BEPS 1.0 was started more than a decade back, and there were draft reports which were being issued, and then final reports were issued. 15 action reports were issued in 2015, out of which the first report dealt with the digital taxation, which never saw the light of the day. And that is the reason many countries, including India, came up with the unilateral measures like imposing of equalization levy, or many other countries call it as a digital service tax. The 15th action report, which is nothing but the multilateral instrument, has been implemented by various countries across the globe, including India, in 2019. However, that was not enough. That never dealt with the complete evasion of taxes. So while MLI does talk about the treaty restrictions and denial of treaty benefits, however, in case of tax havens, where profits are being shifted and where taxes are not paid to any of the government, and therefore there were many examples where any income remained untaxed in more than one jurisdiction. With this backdrop in mind, two-pillar approaches were being suggested by OECD, which was then followed up by G20 countries, which is Pillar 1 and Pillar 2. So friends, what is Pillar 2? What does it try to do? What is its main objective? And who is going to get tax out of it? The very important objective of Pillar 2 is to disincentivize the tax-driven cross-border structures where there is not much of the substance, and having tax benefit out of the tax haven is the prima facie object. The aim is to end race to bottom, that is, provide a level playing field for jurisdictions and taxpayers. So there has been a huge competition on tax because of the lower corporate tax rates in certain countries. Investments are being invited in those countries and structures are rooted through those countries. So in order to reduce this race to bottom, Pillar 2 tries to provide a level playing field to all the taxpayers across the jurisdictions by levying something which is called as minimum tax of 15%, which any M&E group will have to pay. What do you mean by M&E group? who will get covered into this, what they will have to pay, we will study in detail in next 1 hour. So there are coordinated set of rules which are being given under Pillar 2 to address profit shifting and unhealthy tax competition. It provides jurisdiction with the right to tax back where the host jurisdiction, where that is the source jurisdiction, do not levy the minimum amount of taxation. So it is within Pillar 2, there are two main rules. One is STTR, which is called as subject to tax rule, which provides additional withholding tax right to a payer jurisdiction on certain related party payments if payee jurisdiction is not taxing the same income at minimum 9% of the tax. We also have slide and the case studies in order to understand what is STTR and what are globe rules. So STTR and globe rules are the two main areas under Pillar 2 which we will study today. This slide gives a timeline, the journey of the Pillar 2 so far. So while I will not go back right from 2012 what has happened, but in the recent past, which is very important for us to understand. So October 2020, OECD Pillar 1 and Pillar 2 blueprints were issued. There are significant differences between the blueprints and the globe rules which we have on the statute. After the blueprints were released in October 2020, in July 2021, inclusive framework statement on Pillar 2 and Pillar 1 was given. Thereafter, in October 21, there was an updated statement from the inclusive framework and G20 endorsements. And finally, in December 21, the model globe rules have been issued by OECD and G20 countries. Thereafter, in March 22, a detailed commentary on the globe rules have been issued. Globe rules itself is running into more than 100 pages and commentary is running into more than 225 pages only for the globe rule. This itself suggests the intensity and the complexity of the subject, what it is. Thereafter, in late 2022, globe rules, coming late 2022, that is right now we are in September 22, we are expecting that by December 22, there would be an implementation framework which would be issued by OECD and G20 countries about how to go ahead and implement. So for example, how the administration process will work, which country will collect, how information will go to tax department, what kind of return needs to be filed, what kind of information needs to be submitted, etc. And there would be a public consultation and finalization of STTR rules. So, friends, earlier it was expected that STTR rules would be finalized much earlier and commentary on those rules would be issued much earlier. However, to everybody's surprise, what OECD G20 has done is globe rules have been issued earlier along with the commentary and STTR is still under the consideration. And the reason over here is that STTR is a treaty-based change. And there would be another multilateral instrument which would be required in order to implement STTR. However, globe rules is not treaty-based change. Globe rules needs to be part of the domestic law of the respective country, and therefore each jurisdiction across the globe is in a great race to implement the globe rules. 2 weeks ago, we had a statement from 5 European countries which mentioned that at any cost by 2023, they will implement the globe rules. So we hardly have a few months to plan ourselves and to be ready for the implementation of the globe rules. Then in 2023, we are expecting IIR to be likely to be in effect. So under globe rules, there are two main elements. One is IIR, that is income inclusion rule, and another rule is called as UTPR, that is under tax payment rule. We are going to study each and every concept, each and every rule along with examples, case studies in detail. But just to explain you, within globe rules also, out of the two rules, which is IIR and UTPR, IIR will come into effect earlier. That is, it is expected to be into effect by 2023. Again, this is a very, very ambitious timelines. Whether this will be achieved or not, we really need to wait and see. But if not 2023, I mean, at least by end of 2023, we are expecting it will certainly come into picture. And UTPR will come into picture 1 year down the line. That will be, say, 2024. With this understanding on the timelines, let us understand what are the hierarchies and the rules which one need to follow under Pillar 2. So there is a specific hierarchy which has been given. Okay, first you have to apply subject to tax rule on any payment. So the dichotomy is that STTR has to be applied first, but STTR rules are not yet finalized. Globe rules are finalized, but Globe rules hierarchy comes after STTR. So second in the hierarchy is Globe rules. Under Globe rules, okay, if you read 2A, 2B, 2C on the screen, all these three comes under the Globe rules. And this is the hierarchy which has to be followed. That is, the first right of tax would be given to the source country from where the income is getting generated. So after Globe rule coming into picture, if some country believes that if I don't tax, some other country is going to levy tax on income which is generated into my country, then better let me only levy the tax. So that sovereign right to the country is being protected, and there is a concept of domestic minimum top-up tax which a source country can come up with. Thereafter, it is Globe IIR, that is Globe Income Inclusion Rule. And thereafter, as a backstop to the IIR, there is a Globe UTPR rule, that is Globe Under Tax Payment Rule. We need to keep this hierarchy in mind when we apply a case study, when we read into any question, when we think of any structure, that how my tax as a group is going to get taxed, in which jurisdiction, how much it will be taxed, what is my current effective tax rate, after Globe coming into picture, what would be my likely effective tax rate, whether I would be out of cash, whether I would have to suffer, whether there would be lower returns to my shareholders. All these things needs to be kept in mind. So as a concept, let us understand what do you mean by subject to tax rule, which is the first in the hierarchy. As I mentioned, subject to tax rule is additional top-up withholding tax rights which is given to the payer country on certain covered payments. So it is not by default applicable to every kind of payment. There are certain categories of payments which are being defined as a covered payments. It is applicable only for those covered payments to connected persons, subject to nominal rate of tax in the recipient jurisdiction below 9%. Now here, friends, it is important that this rule is applicable as on today. As per the blueprint version, it is applicable only to the connected persons, unless we see a difference in the model rules which are going to come up for the STTR. And when we come to UTPR, I will explain you, UTPR is not limited to the payments to connected persons. UTPR as it stands today also applies to payments made to third parties. So this is a very important distinction one needs to keep in mind. And the second condition is that in the hands of the recipient jurisdiction, one has to see whether that recipient country is taxing that income at 9% or no. In that case, the payer country will get right to levy that additional withholding tax. And what would be that right? So it will not be entire 9%. It would be to the extent of the shortfall. So suppose in the recipient jurisdiction, it is getting taxed at say 5%. In that case, 4%, which is the shortfall, would be the additional top-up withholding tax, which payer country will have right to tax as in the form of withholding tax. This is, as I mentioned, treaty-based implementation. So friends, today we have one MLI, which has been implemented in 2019. Whenever Pillar 1 would be implemented, for amount A of Pillar 1, there would be another MLI which would be in place. And once STTR rules under Pillar 2 is implemented, in that case, there will be third MLI which would be in place. So friends, please understand the complexity as an international tax practitioner when you are advising to any client on availability of the treaty benefits. Now, apart from the base treaty which we have in place, we will have to read 3 MLIs on top of it in order to come to a conclusion like what would be a simple withholding tax rate on a particular kind of payment. So this makes our subject very interesting. What are the covered payments which are given under STTR? So on the left hand side of the screen, you can see some of the covered payments which are listed are interest, royalties. As you can see, royalties is there, but fees for technical services is not covered explicitly. There is franchise fees or other similar payment for use or right to use intangibles. Now here again, there could be host of litigation because today not necessarily that on all franchise fees withholding tax is being done. Whether there are arguments which are taken that, whether the franchise fees is related to a permanent establishment and what is the net income, etc., etc. Here, what we are talking about is withholding on a gross basis. Insurance or reinsurance premiums, guarantee, brokerage or financing fee. Guarantee is a very common transaction which we see between the intercompany transactions. So parent generally gives a guarantee, right? And there is a guarantee commission. And again, there are arguments. What is the nature of that guarantee commission? Is it an interest income? Is it a FTS or what it is? And whether withholding needs to be done or not. But after this coming into picture, it explicitly says on any kind of guarantee fee, withholding tax will have to be levied. Rent or other payment for use or right to use movable property. Consideration for supply of marketing, procurement, agency or other intermediary services. Now this is widely open, other intermediary services. What can be covered, okay, is anybody's guess. What is not covered explicitly today is capital gains and dividend. Now, India being a developing country, there is a lot of thrust on levying STTR even on the dividend income, as a lot of listed companies in India or even unlisted companies in India also gives dividend to a lot of foreign shareholders. And wherever it is not getting taxed, so today under our domestic law, we have 20% withholding tax rate on dividend and subject to the treaty benefits. Now, wherever we have most favored nation clause applicable and say dividend tax rate under the treaty goes down to 5%, and say in the recipient country, dividends is not taxed. For example, say Singapore, okay, or for any other example, say today Dubai, there is a plan to come up with a corporate tax 1 year down the line, but as on today, there is no tax, right? So if dividend is covered under STTR, in that case, any MFN clause is applicable. So additional withholding tax would be required to be done. What about capital gains? There are so many transactions. Even today, for example, Netherlands treaty gives a capital gains exemption. So in that case, on capital gains, there is no withholding. Or those grandfathered treaty like Singapore or Mauritius, where capital gains is not taxable into India because of the treaty protection. Whether STTR would be applicable to that or not is something which we will have to watch and see. As on today, it is not covered. And if capital gains comes, it may not be restricted to connected persons. It may be even beyond connected person, which is a third party transaction. Connected person has been defined like a person would be connected to another person if one possesses greater than 50% of the beneficial interest or aggregate vote and share value or beneficial equity interest in another. A third person possessing the above requirements in both the persons, so directly or indirectly. Let us understand this case study on STTR. So say there is a parent company which is located in low tax jurisdiction. Let's go ahead with the same example of say Dubai, UAE, and it is having a subsidiary in India. There is borrowing which is made by the Indian company in a foreign currency at say arm's length interest rate of 10%. So let us assume that from the FEMA, this is an ECB compliant transaction from transfer pricing, thin capitalization under 94B is being met. There is an arm's length rate of interest of 10%, etc. Currently, as per the law which we have, for foreign currency borrowings, if it meets certain criteria, in that case, withholding tax is done at 5% under section 194 LC, which is less than 9%. And now assume that the recipient jurisdiction, which is Dubai, okay, which currently is not levying any tax on this kind of interest income. So in that case, the withholding which is done is less than 9%, and therefore there is a shortfall of 4%. So what will be the impact after STTR kicks in? Will India get right to tax this additional 4%? Or whether as an assessee, we would have an argument to take that if domestic law itself is providing 5%, why should I go to treaty related amendment on STTR, and why should I levy the additional tax? But if STTR kicks in, whether this 5% under domestic law will be retained, or whether there would be any amendment even under the domestic law to increase this. These are very practical examples, live examples in case of most of the clients which we see, and you also may be coming across. So this is only one of the example which I have plotted in. There could be many, like lease equipment. There are certain treaties like Luxembourg where lease equipment is not taxed as royalty and therefore no withholding. So what happens to that? In Luxembourg, if it is a tax haven, in that case, after STTR kicks in, that may get taxed into India. So all these practical examples we will have to analyze once STTR kicks in. With this, let us move to globe rules. Now, all our discussion hence for our presentation today would be on the globe rules. So globe rules is being constructed on 10 building blocks, or you can say 10 chapters. Chapter 1 deals with the scope of the globe rules, that is which M&E group would be in the scope. Globe rules would be applicable to which M&E group. It will not apply to each and every kind of assessee. So that is a paramount first thing to determine that whether I am in scope or whether I am out of the scope of the globe rules. Second thing is the charging provisions. Once you are in scope, okay, then which country will get right to tax? Which country goes ahead with IIR? Which country goes ahead with UTPR? What if a country is a silent? So charging provisions, very important. Thereafter, next 3 chapters talks about the calculation part of the top-up tax. That is main tax which government would be running around to collect those taxes. So there is a particular methodology, detailed methodology, lots of adjustments which have been given for computing how a globe income has to be computed. Now this computation is different from our accounting computation. This computation is different from our normal tax computation, which we have been doing so many years for our clients and assessors. Then how to compute adjusted covered tax. Having computed covered taxes and the income, then you come to what is the effective tax rate, what is the shortfall to the 15% rate, that is what is the top-up tax rate, and then what is the amount of the top-up tax, and then which jurisdiction needs to collect the top-up tax. What happens in case of corporate restructuring? That is given in chapter 6. Then there are some special regimes on the distributive regimes. Chapter 8 deals with the administrative aspects. So for example, as on today, the rule suggests that globe return has to be filed within 15 months from the end of the globe year. Now, which entity has to file that return? So like we have something in CBCR, we will have to define the constituent entity which would be filing the globe return even over here. Then there are transitional rules and then the definitions which have been given. So friends, let's understand, as I said, first and foremost, okay, whether me as an assessee, I am covered into the globe rules or I am not covered, that is a paramount importance for me to find out. So first thing is identifying which M&E group is within the scope. The rule says that those M&E group where consolidated revenue is greater than or equal to euro 750 million, that M&E group is within the scope. So unlike pillar 1, where there is a huge threshold of 20 billion euro, here the threshold is linked to CBCR threshold, which is euro 750 million. Now, let me pause and let me, make this session more interactive, and, we can give the talking rights if somebody wants to answer or put on the chat box. So what happens if there is an M&E group? Okay, India also has many multinational companies. There is M&E group. It also has turnover, which is more than 750 million, but it doesn't have any foreign operations. Very unlikely, but hypothetically, let's assume that it doesn't have a single foreign operation. Will that be covered over here? Answer is no. there has to be a foreign operations in order to be covered in scope of M&E group. What happens if a group is being covered, governed by the individual or promoter shareholding? So suppose ultimately it is held by individual. Okay, so I'll just give you some examples. Say all Tata groups, Tata entities, ultimate parent company, say Tata Sons, correct? If you can take some example where ultimately it is held by an individual, in that case individual or promoter is specifically out of the scope. What happens in case of joint venture? What happens in case of associates, portfolio companies? Let me come to joint venture a little later. Okay, let me first cover also, while I'm covering individual, what happens in case of a branch. So now we are going to the second limb, which is constituent entity. So if you are consolidating the revenue of various entities within your group, and you are coming to a conclusion that consolidated revenue of the group is more than euro 750 million, then you are in scope. But does that mean that each and every entity in the group is covered across the globe at each and every jurisdiction? Partially answer is yes, partially no, because there are specific rules given over here. You have to identify which are the constituent entities. So for example, say branch. What is the residential status of branch? Branch is a permanent establishment. It's a non-resident. For permanent establishment, they have given a coterminous status like a subsidiary. And P has to be considered as a separate constituent entity for the purposes of globe rules. What happens to liaison office and project office? Those are not permanent establishment. So those would be out of the scope. Those will not be considered as constituent entity. What happens to limited liability partnership or the partnership firms or trust? All those structures are covered, explicitly covered. What is not covered is individuals. Now, what happens in case of joint venture? What happens in case of associates, portfolio companies? So friends, we will now have to go back and learn accounting concepts which we had studied as a part of accounting student either in college or in CA exam days. And if as a tax professional we are not in touch with accounting, globe rules will make us go back to the accounting because of many reasons. We need to revisit the deferred tax asset, deferred tax liability, deferred tax as a concept, and it can have a huge impact on the effective tax rate calculation. And because of considering the deferred tax, you may be out of the scope because you are already said more than 15%. But if you exclude deferred tax, you may be in the scope because say the result may come to less than 15%. What happens, in case of the reversals? What happens if there is no positive outcome? So deferred tax asset is created, if you remember the accounting days, if there is a probability of the cash profits in future for tax. So what happens if there is no such probability? Now coming back to the joint ventures, associates, etc. Whether joint venture gets consolidated on a line-by-line basis? Answer is no. The litmus test over here is that those entities where you consolidate your books of accounts on a line-by-line basis, those are covered under M&E group scope and other entities are not. For a joint venture under Ind AS, the accounting, the way it happens is it is accounted on an equity method basis. That is, only profit from the joint venture is being considered. However, for globe purposes, again, there is an exception which has been given. So what Ind AS accounting principle says for joint venture, those you don't have to remember. We have to keep globe as our Gita. Okay, we have to keep globe as our Bible. And what globe says, okay, that is only to be followed for purposes of computation of globe. So we will come to joint venture. I have a case study. I have examples. What happens in case of joint ventures? But associates are certainly out. Portfolio companies are certainly out. In portfolio companies where you have less than 10% of investment, there is no line-by-line consolidation. Similarly, in associates where you have 20% or less, there is no line-by-line consolidation. And therefore, those entities are out. Having said you are a M&A group, after having identified, okay, suppose I have 100 companies within my group. Out of 100, I find out, okay, which are the constituent entities which get covered over here. Then you have to see, okay, which constituent entities I have to exclude. So there are certain excluded entities which have been given. For example, if those are governmental entities or NPOs, not-for-profit organizations, or pension funds, etc. And then you have to see the location of each constituent entity. Why this is important? Because entire globe rule functions on a concept of jurisdictional blending. Jurisdictional blending means today we are seeing the entity approach. After globe coming into picture, we have to see jurisdictional approach. Today, if we have, say, 20 companies into India, we file 20 returns into India. Okay, we don't offset losses of one entity against profits of another entity, correct? But for globe purposes, what it says is that at a jurisdictional level, you see which are the constituent entities which are in scope, and then aggregate those, and then see that after aggregating those, what is the effective tax rate qua that jurisdiction. Now, it may so happen that on a global basis, your effective tax rate of a group is more than 15%. But in a particular jurisdiction, say you are not paying 15%. In that case, they will disregard that on a global basis. Suppose you are paying 30%. So suppose India as a jurisdiction, now we have 22% rate earlier, and earlier we had 30% rate. So say today we say, okay, in India I'm paying 22% plus surcharge says total 25%. But suppose I have presence in some tax haven where I'm not paying 15% also, then they will disregard what we are paying in India as a global basis, but we will have to pay 15% tax in those jurisdictions, and that will significantly increase the effective tax rate of any multinational group. And I have one example on that. What happens in case POEM kicks in? So suppose there is a constituent entity which is incorporated in X jurisdiction and say it has POEM in Y jurisdiction. So there is no clarification as on today that if POEM kicks in today, we see, okay, if you are a Singapore company incorporated in Singapore, but say POEM is in India, then your residency test falls back to India. And therefore, you will be considered as a company which is resident in India, and accordingly, the taxation principles will follow. But in globe, what happens under this scenario, that has not yet been clarified. With this, let us understand very, very important concept. What is income inclusion rule and what is under tax payment rule? So income inclusion rule is, if I put it in the simple words, it is a top-up tax to be paid in the ultimate parent entity's jurisdiction. So there are so many outbound groups, okay? If we say Tata Communications, Tata Consultancy, RPG Group, or many outbound companies, Reliance, correct? So what happens in a very, very big conglomerate where, you know, you have presence across the globe, and there may be so many levels in which you will have presence. There would be some intercompany jurisdictional head office. Below that, there may be so many subsidiaries. Below that, there may be some operating companies, etc. So the right to collect tax is given to ultimate parent entity. Now, there is an exception to this in case of split ownership. Suppose you don't have 100% ownership directly or indirectly in that particular company. Okay, so we have next slide on this. What do you mean by split ownership? Okay, split ownership is also called as partially owned parent entity. Okay, where 20% if it is held by third parties, then there is rules will change. Rules of the games will change. Then, as we saw the hierarchy, for first right would be given to the source country, that is to levy domestic minimum top-up tax in case they don't want other jurisdiction to collect their taxes. So if any jurisdiction levies DMTT, then the parent entity has to give credit to the DMTT, and then to the extent of the shortfall, ultimate parent entity can collect top-up tax. Then there is a very, very small de minimis threshold which has been given for a very smaller jurisdiction, where say MNE has a small presence, i.e. where it has globe revenue which is less than euro 10 million and globe income which is less than euro 1 million. So suppose you have a presence in a country like say Uruguay, and in Uruguay, your revenue is less than 10 million, and so it's a twin conditions, and your profit is less than 1 million, then even though it is part of your group, you don't have to consider Uruguay as a jurisdiction, and you don't have to collect the balance shortfall top-up tax which you are not paying in Uruguay. That is just one of the example I am giving. Now let us understand what do you mean by under tax payment rule. So now this is a backstop to IRR. This rule is not by default. By default rule is IIR. If IIR fails, in that case UTPR kicks in. If a country does not adopt IIR, then other country which has adopted globe rules that can collect tax under UTPR. So it is a backstop to IIR. So what happens is in under UTPR rule, either there will be denial of deduction, which is being made from that jurisdiction to the low tax jurisdiction, or there could be any other similar adjustments by way of which that country will get right to collect tax under tax payment rule. As I mentioned earlier, unlike STTR rule, this rule is not limited to third-party payments. In fact, this rule can collect higher taxes which IIR cannot collect. And the reason I say this is that under IIR, you can collect taxes to the extent of your stake into that particular company. So directly or indirectly, suppose you are holding 95% stake in that company and say the shortfall, that is a top-up tax in a particular jurisdiction, comes to say 1,000. In that case, you can collect only 95% of 1,000, which is 950. But suppose ultimate parent entity jurisdiction does not go ahead with IIR, and the right to tax comes with some other jurisdiction under this particular structure under UTPR mechanism. Under UTPR, you can collect entire 1,000. You don't have to restrict yourself to 950. And suppose there are more than one group companies under UTPR, and every jurisdiction will say, I also want to tax, I also want to tax. In that case, there is a proportionate mechanism which has been provided, which reads like this. So suppose if we take a simple example, okay, so the proportion which is given is for the weightage is given to employee, that is our tangible presence in that country, and weightage has been given to assets, tangible assets in that country. If you observe over here, intangible assets are not covered. So IPRs are not covered. Only tangible assets are covered. So the way it works is that you have to give equal weightage to these two particular elements, which is employee and tangible assets, 50% each. So you see, if there are, say, total 3 jurisdictions who is claiming that I want to levy tax under UTPR, then you have to take employee count of one jurisdiction, divide by total employee count of all 3 jurisdictions which are implementing UTPR, and multiply that by 50%. You will get answer X. Plus, you will have to see the tangible assets, value of the tangible assets in that one jurisdiction, divide by total value of the tangible assets in all 3 UTPR jurisdiction. Again, multiply by 50%. You will get answer Y. X plus Y is the amount of that top-up tax which one jurisdiction will get right to tax. Likewise, whatever the other jurisdiction, X plus Y is the answer, that other jurisdiction will right to tax. So this 1,000 in my example will get divided among these 3 jurisdictions which is implementing UTPR in the ratio of the employees and tangible assets that it has. Let us go to next slide now. So in the previous slide, I mentioned about split ownership. So by default, how IIR works is top-down approach. That is, ultimate parent entity gets right to tax, the top-up tax. And then there is an exception which has been given in form of a split ownership, which is called as a partially owned parent entity, that is POPE. Let me explain you by way of example, which is there on the screen. So say there is state A and there is ultimate parent entity ACO in state A. It is having 85% stake into BCO, which is an intermediate parent entity, and say BCO has 100% stake in CCO, which is in a low tax jurisdiction. And right now in this example, I am not asking you to compute TUT, that is top-up tax. Let us assume the top-up tax is 100 in this low tax jurisdiction. Now my question to you is, which jurisdiction will get right to tax this 100? So in this first scenario, what we are saying, since the ultimate parent entity has 85% of the stake in VICO, which is more than 80% stake, and VICO has 100% in SICO, so the indirect ownership of ACO into SICO is 85%. And therefore, ACO being the ultimate parent company will get right to tax, top-up tax of 100 to the extent of 85%, which is 85. Now, when we come to the next example on this screen, okay, the answer will change. And in the next example, suppose the everything other thing remaining the same, say ultimate parent entity has 75% stake in VICO instead of 85% in the earlier example, and say 25% is held by third parties. Now in this case, because more than 20% stake is held by third party, VICO becomes POP, that is partially owned parent entity. All listed company, for example, in India may become POP because 25% stake is being held by third parties in a listed company, correct? In this case, the right to tax will shift from the ultimate parent entity to VICO jurisdiction, that is state B. And state B will get right to collect the top-up tax. Also, the amount of top-up tax which it will collect will also undergo a change. In the earlier example, only to the extent of 85 it was getting taxed, and 15 nobody was taxing across the globe. In this example, because VICO has 100% in SICO, VICO will collect, B jurisdiction will collect entire 100 of top-up tax and will pay to the government of B company. And here there is nothing which is not getting taxed. So we have to understand these concepts very carefully before determining answers, before coming to any conclusions, because just any change in the percentage shareholding will have a very, very far-reaching change in the impact and the amount of the taxes which government has to collect it, how much it has to collect. Let us go to next slide now. Now here I want to explain the concept of a joint venture. What happens in case of a joint venture? So above 3 bullets, A, B, C, okay, are the 3 conditions which are given. And if these 3 conditions are met, okay, then even JVCO becomes an Inscope M&E and otherwise not. Now, what does this mean? Okay, so what is the basic difference between the joint venture and a subsidiary? So suppose you have, say, 60% stake in some company, or say 90% stake in some company, and in company A, and say you are having, not in this example, I'm just giving you some other examples. Suppose you are having 90% stake in a company A and you are having 50% stake in company B. Now, what is how do you determine that one is a JV, other is not? In both the cases, you are having more than 50%. So the answer to this is that in case of joint ventures, apart from the ownership stake, what is also important to be seen is that whether both the parties have a joint control on that particular entity, or whether you have a single control. If there are joint controls, okay, between 2 groups, then that particular entity becomes a joint venture entity. Now, if that entity becomes a joint venture entity, and now let us come to this particular example. Okay, and before this, let us also read the 3 conditions which are there. So, as I explained, under accounting, joint venture is not accounted as line-by-line consolidation. There is an equity method of accounting which has been followed. So, if this is the one condition which is met, the second condition is that ultimate parent entity of such M&E directly or indirectly holds more than or equal to 15%. So it says at least 50%. Okay. So in this example, okay, we'll take both the scenarios. Suppose A and B holds 50% each, then what happens? Or say A holds 60% and B holds 40%, then what happens? So one of the second condition, the requirement is that you should have minimum 50% ownership in that particular JV. And the third test is JV group itself is not subjected to globe rules. So what do you mean by this? First, you have to see whether JV group itself is subjected to globe rules. So under JV group, say there are multiple subsidiaries. Okay. So after considering all those subsidiaries, JV company also would be preparing its consolidated financial statements. Now, as per that, if JV company's revenue itself is more than 750 million euro, and if the jurisdiction in which JV company is located has adopted globe rules, in that case, JV company itself becomes an MNE group, and that has to be seen separately. Thereafter, the members or the partners in that JV group is not concerned, and they will not have any liability to tax. So here the liability to tax will fall down to the JV company, and the jurisdiction in which JV company is incorporated or is there, that jurisdiction will have right to tax. Now let us understand the example which I have on the screen. So see, there is ACO, which is an Inscope MNE. Otherwise, without even considering JVCO, it is an Inscope MNE. Similarly, say BCO is also an Inscope MNE without considering JVCO. And say both of them, if you see the right hand side of the table, what I have mentioned is scenario 1 and scenario 2. Let us first discuss scenario 1. So scenario 1 is A and B holds 50% each in JVCO. And say JVCO and its subsidiaries, they both are located in a low tax jurisdiction. And say the total top-up tax of JVCO and its subsidiary comes to say 1500 putting together. So now the question is, which country will have right to tax this 1500 and how much? So considering these are the two equal partners, which is 50% each, and considering, let us also assume that JVCO's consolidated revenue is only 400 million. So it doesn't exceed 750 million euro. And therefore, JVCO itself as a group is out of globe rules. And that is why we are seeing the applicability in the hands of the members or the partners or the parents. Because JVCO is out of the globe rules itself, that is why A and B have to analyze whether they have to include JVCO's tax in their jurisdiction and pay to their government or not. So answer is yes, A and B will have to collect 50% of tax each and will have to deposit with their government. Now, what will happen if say ACO has 60% stake and BCO has 40% stake, but both have equal and joint control on the JVCO? Now, in this case, because the second condition on the screen, which is that you should have at least 50% of ownership, is not met by BCO, and therefore BCO will not have to consider the TUT of 1500 to the extent of 40%, and it will not have to pay to its government. So it will be only ACO which will collect 60% of 1500, that is 900, and will deposit with the jurisdiction of ACO. And balance 600 will remain untaxed in this particular example. We can take any questions which we have at the end because this is really complex. Now, let us understand the globe rules, the hierarchy, what we just saw, along with the example and what impact it can have on any particular multinational entity. So there is an ultimate parent entity in state P, which is a high tax jurisdiction. When I say high tax jurisdiction, it is more than 15% rate, corporate tax rate. Okay. Now it has three subsidiaries, 100% each. One in state A, another in state B. These both are high tax jurisdiction, and state C is a low tax jurisdiction. Now let us see the numbers which are there on the adjacent table. So say the profit or loss in each of this company is as under. Say profit at the level of ultimate parent entity is 1000. For subco A, profit is 2000. For subco B, say there are losses of 5000. And this is a different jurisdiction. So we don't have to do the jurisdictional blending over here. And say subco 3, the profit is 4,000. So corporate tax rate in each jurisdiction is like this. At ultimate parent entity, it is 30%, very high as per 15%. In company A, jurisdiction A, say it is 20%. In state A, say it is 30%. Okay, so all these are higher than 15%. And in state C, say it's a zero tax. There is no tax in Dubai as on today. So what is the tax which this group is paying is coming under next column, which is at first level, it is paying 300, then 400, etc., totaling to 700. And on a total income of 2,000 for a group, when I do the consolidation, correct? I'm not talking about a jurisdictional blending. Here I'm talking about at a group level. There I will get the set off of 5,000 rupees of losses which are there in subsidiary B. So my total income as a group for that year becomes 2,000. So the pre-tax globe income, which is 700, divided by 2,000, gives me an effective tax rate of 35%. Now let us see how there is a change in the table when globe comes into picture and what impact it will have on this M&E group. So because in first three cases, the corporate tax rate and the effective tax rate says more than 15%, so there is no impact. But in company C, which is in state C, since there is no corporate tax rate, okay, and therefore 15% is basic minimum which it will have to pay in state C. So the top up tax in state C is 4,000 into 15%, which is 600. So now the total tax which I am paying as a group is 700 plus 600, that is total 1,300. This gives me an effective tax rate of 65%, which is 1,300 divided by 2,000. So earlier, where my effective tax rate was 35%, goes up directly to 65%. And there can be multiple permutations, combinations when we take any big group as an example. Just imagine if this is really implemented in a 1 year down the line, which is really expected, then what impact it will have on a very, very big M&E group. And therefore, a careful planning analysis is required in a detailed manner so as to see what will be the impact and whether it can be mitigated in any manner. Next slide. We still have 15 minutes, so I'll cover quickly. Next slide is DMTT, IIR, and UTPR case study. So say there is a Luxembourg company, which is the ultimate parent entity. And below Luxembourg, say there is a Netherlands company where Luxembourg holds 75%. And such 25% of stake is held by third parties in this Netherlands company. Further, Netherlands company has two parallel subsidiaries, 100% each in India and in UK. Now say corporate tax rate in ultimate parent company, which is Luxembourg, is say 25%. In India, also say corporate tax rate is 25 and effective tax rate is also 25% on a simplicity basis. We have kept it same. Not necessarily that the effective tax rate will always be the same as the corporate tax rate of that particular country. And say at UK, income is $100. Corporate tax rate is only 19%, but it is much more than the 15% minimum tax. But my effective tax rate in UK is only 8%, which is possible, correct? Now, therefore, the shortfall to the 15% top-up tax is 7%. So question is, who will have right to collect 7% of $100? That is $7 in this case. So which country will have right to tax this? So we have to test all the hierarchies. We have to test and see what each jurisdiction has implemented. So if UK imposes DMTT, then 7 would be collected by UK itself. But suppose UK does not impose domestic minimum tax, then who will get the first right to tax? Say Luxembourg goes ahead with IIR. Also say Netherlands goes ahead with IIR. So who will get right to tax? Anybody, can I have some answer in chat box, please, or whether everybody has just gone on mute? So the right to tax here which will be with the Netherlands company, because Netherlands company becomes a partially owned parent entity because more than 20% stake is held by third parties. So $7 would be collected by Netherlands in case UK does not impose DMTT. Now, say for some reason Netherlands does not go ahead with IIR, and so Luxembourg also does not go ahead with IIR. Now, in this organization structure, India is one another company. So, and say India goes ahead with Globe rules. So, India will get right to tax this $7 under UTPR rule if neither UK taxes nor Netherlands taxes. So, this is how it works. And this is example where I have taken just 4 companies on this particular slide. When you plot more than 100 companies on a slide and when you try to see the impact, it is a real nightmare. Next slide.
Madam, if the Netherlands company is not a POC, then what will happen?
So then right will go to Luxembourg company.
And if the IRR is, and the Luxembourg is not implementing the IRR, then?
And right will go back to India.
Then again it will come back to India.
Yes.
Okay. Okay.
Yeah. In the interest of time, we will not go into much of the detail, but now, there are very, very complex rules running into more than 50 pages each, which are given for computation of globe income and for computation of covered taxes. So the starting point is that you have to see the net income or loss of a constituent entity as per fit for consolidation accounts. Now, what do you mean by this? So suppose you have presence in 100 countries and say different currencies are followed in different countries. So first you will have to convert all the financials into an currency which is being followed by the ultimate parent entity. So first you have to make those accounts fit for consolidation accounts, and then you have to consider income or loss of that particular constituent entity as a starting point. Having done that, then there are various adjustments which are to be made. For example, dividend income has to be excluded as a part of the globe income. So if there is intra-company dividend or even dividend from a third party, that has to be clearly excluded. Now here there is one exception which is given in case of a portfolio dividend. So what happens is, in case of a portfolio dividend means where your stake in a particular company is less than 10%. There, what rule says is that if you are holding that stake in that particular company for more than 365 days, then you have to exclude the dividends. But otherwise, if you are holding it for a shorter period, then for a portfolio company, you have to include the dividends. So this is just one example which I am giving. Likewise, there are so many detailed points which have been mentioned in the rules. Then excluded equity gain or loss. Now what happens in case of Ind AS? There is a fair valuation, correct? Fair valuation, and you have to, if there are any equity instruments which you have to fair value it. And then under Ind AS, you have notional income, notional gain, etc. So that has to be excluded. But again, you have to make an election for that exclusion. Again, what happens to capital gains or losses? So capital gains have to be excluded in case it is not your portfolio companies. If it is your portfolio investment, then you have to include capital gains. Stock-based compensation. Again, that you have an option to elect that I want to consider this only on the actual basis and not on a notional basis. So based on that election, what a constituent entity makes, those particular adjustments needs to be done. So as a consultant, you also need to know, okay, what election your client has made and in which jurisdiction and for how many years. No deductions are given for bribes, penalties, etc. This is something similar to like section 37(1) of our Indian Income Tax Act. No penalties is allowed to be deducted. If I have to give you example on how covered taxes is calculated. So covered taxes is the terminology used in the rules is adjusted covered taxes. So this is a numerator. You have to divide this by the globe income, which is the denominator, in order to come to the answer of effective tax rate. So certain elements which are to be included as a part of covered taxes, corporate income tax, obviously, and deferred tax only up to 15%. So there is a concept that you have to recast deferred tax asset or deferred tax liability only to the extent of 15% rate, which is the global minimum rate. If it is more than 15%, then you have to exclude it, as you can see in the next table. If there are any CFC taxes which are levied by any parent jurisdiction, then those are to be included. Withholding taxes are to be included. If you are paying any taxes under STTR rule, which is the first in the hierarchy, that is to be included. If you are paying any taxes under Pillar 1, then that is to be included. The more amount which is allowed to be included as a part of cover tax, your numerator is higher. Your numerator is higher, your effective tax rate is higher, the amount of top-up tax goes down. When you come to the exclusion, it says that top-up tax you don't have to consider. You are doing this exercise in order to arrive at the top-up tax, and that is the reason you don't have to consider and start with the top-up tax. Any kind of equalization levy or digital service taxes, those have to be excluded. Payroll taxes, property taxes, excise or indirect taxes needs to be excluded. And deferred tax, as I mentioned, if it is more than 15%, then that is to be excluded. So now this next slide gives us a flowchart of how to compute top-up tax. So earlier we discussed whether you are in scope or not. Then we discussed which country will get right to tax. Now we are discussing how do you need to compute top-up tax. So there is globe income. There are covered taxes divided by globe income that will give you answers for effective tax rate qua that jurisdiction. Now, suppose effective tax rate qua that jurisdiction is say 12%, okay, which is less than 15%. So 3% becomes your top-up tax. So you have to see what is the shortfall. And you don't have to apply that shortfall entirely on the globe income. There is one more exception and the carve-out which has been given from the globe income, which is to be subtracted, which is called as substance-based income exclusion, SBIE. How this is being computed, I've given a table below. So that is again linked to the payroll cost of the employee and the book value of the assets, tangible assets which are located in that jurisdiction. This only says that if you have a substantial presence in that particular jurisdiction, then for that substantial presence in a tangible form, that carve out is being given, and therefore from the globe income you have to deduct this substantial presence which you have and find out what is your excess profit. From that excess profit, if the country is levying domestic minimum tax, then that has to be deducted. Then you arrive at the base amount of top-up tax for which each jurisdiction would be fighting. I want to tax, I want to tax. And then on that particular top-up tax, then you have to find out which constituent entity you want to allocate. So whether it is ultimate parent entity or whether if it is not UP is not going ahead with IIR, then under UTPR, if there are more than one entities, then which entity will get right to tax, etc. With this, let me come to the last slide, and I'm within the time. So last slide gives the practical example of the top-up tax flowchart, which we just saw below. So say there are covered taxes of 100. Okay. Globe income of 1,000. Effective tax rate of that jurisdiction, 100 divided by 1,000 is 10%. Top-up tax, which is a shortfall, is 5%. SBIE, that is the carve-out which is given for tangible presence, is say 200. So from 1,000, you have to subtract 200 in order to derive excess profit of 800. On this 800, you have to apply the top-up tax shortfall percentage, which is 5%. So 800 into 5%, you get answer of 40. And this becomes your jurisdictional top-up tax, which other countries will get right to tax. So friends, with this, I have tried to explain each and every concept in a great detail. There are so many complexities which are given in the rules for various concepts, and there can be multiple permutations, combinations, scenarios over here. And therefore, once this rules comes out, it would be a great topic of debate. It would be a great, I would say, chaos. And unless the administration rules comes out, which are expected by end of this December, one really needs to see how practically this will work and whether softwares are aligned, whether companies are having all these numbers, database, whether tax jurisdictions is having any database, in order to say, what you have done, what written you have filed is incorrect, is something very interesting, which we will have to see.
Before Mr. Singh comes in, sir, just one question Smita Patni, Monika, for you. Maybe you had answered it because I think Prakashji probably had asked it. In your case study 2, where Netherlands doesn't have IIR, then India will tax it as IIR or UTPR directly is the question posed by Smita.
UTPR. India will tax it as UTPR.
Okay. So that's the answer for, Smita had a question in chat box.
Sure.
I thought I'll kind of just put it across. Sir,
Sure.
over to you, sir, please.
Thank you. Thanks. It was a very, very superb presentation by both the presenters. Now, when we look at Pillar 1, Pillar 2, let us talk about the positives, and then I will talk about, the challenges. I won't say negative, but challenges. Now, the positive thing, if we look at, both Pillar 1, Pillar 2 come out very strongly in two aspects. One, they are very clear in identifying three aspects of taxation, which are basic to any tax rules. That is, who is to be covered under that, how is to be covered, and how is to be implemented. So who, how, and what are the three aspects which have to be dealt with for any tax law. So whether it is amount A or Pillar 2, these three aspects have been brought out very clearly by the OECD. And the other aspect, which is very significant, and in fact, Monika and both Partho have dealt with. Monika has come out with like a true, accountant with numbers. Is that there is very little scope they have left for the qualitative, interpretation of the provisions, and they have tried to go for the quantitative, because in quantitative and considering that there will be multiple jurisdictions going on the qualitative, the basis for identifying any income will give rise to multiple litigation. So they have tried to minimize that by emphasizing on the quantitative aspect, and that is why all the numbers which both the presenters have talked about, it becomes very, very significant and very important. So these are the two, two classes of positive aspects. There, the challenges which are there are that all the countries have been, following a particular way of accounting. Monika has mentioned it a couple of times. That you have to learn it, you have to unlearn it. Several aspects. Because in order that there has to be a common understanding in respect of distribution of income. The last example which she talked about, India, UK, Netherlands, Luxembourg. All these 4 countries, until unless there is some uniformity in understanding accounting principles, there will be chaos. There will be, a lot of litigation. Everybody, all the tax jurisdiction, the authorities will try to protect their revenue, and there will be multiple taxation. That's one aspect. The other one is a very basic question which comes to my mind is why there are 2 types of the threshold, in respect of amount A and in respect of Pillar 2. Pillar 2 is 750 million euro, whereas so far as amount A is concerned, it is 2 billion euro. Is it because Pillar 1, Pillar 2 is basically, the amount is flowing back to the ultimate parent entity. So therefore, the threshold has been kept lower, so that most of the multinational enterprises which are coming from the developed countries, the profit ultimately flows back to them. That's one. The other one is, so far as the amount A is concerned, the threshold have been kept very high, because that gives the right of taxation to the jurisdictions. And what, in fact, Sanjeev mentioned, doing the, the back of envelope computation is huge number. So there will be very few. So very few countries will be subject to taxation on the basis of amount A in respect of the market jurisdictions. So these are some basic. This is a very, very basic question which has been raised. I mean, Prakash will, agree with me. I mean, even when the presentation was made, in respect of amount A, Mr. Chaudhary, who was in the panel, raised this question that it is not totally in favor of developing countries. So these are some questions which, down the line, the international organizations will have to consider sympathetically towards the developing countries. But the thing is that if it's going to be, adopted, as many countries in Europe have made their intention very clear, and the more the number goes up, the pressure will be on other countries to adopt it. So we need to, relearn, several accounting principles and taxation principles. Thanks a lot to both the presenters. It's a very complex thing which we will have to understand. But if you look at taxation is not simple. Accounting is not simple. But since we have been doing it for many, many years, now those things are, we take it for granted. Same thing, maybe, a couple of years for the young people to relearn, they will be able to understand. I'm not so sure about people of my age or my generation, how fast they will be able to understand it. But yes, there are challenges, but there are opportunities, particularly for the consultants. There will be huge and challenges for the tax authorities.